Oh, sorry, I was talking. I didn't know I was muted. So, like I said, I am Bukola Alale, and I'll be walking you through the remaining part of this chapter 3, accounting equation. Then we'll do the remaining parts of, we'll move into chapter 4 as well. Then we'll see how I will try as much as possible to be fast so that we can cover more at a high speed. So you can have enough time to read. Hopefully, during the week, I will have time to be able to so that we can look into past questions relevant to everything we are doing. So welcome everyone. Yesterday, I think I gave us something to do yesterday. So I know Amarachuku was around, Fizi was around. I know Olusheye was not around, right? This woman was around. I thought I handed her, right? Has she joined? Anyway, so Babatunde Edu, Ifunaya, were you around yesterday? Yesterday, can you hear me? Nobody's talking. Babatunde Edu, Ifunaya, were you around yesterday? 1, 2, 3, 4. Were you around?
Yes, I was around, but I joined the class late.
Yesterday, Abby?
Yes, sir.
Okay, thank you. Ifunaya, were you around yesterday? Anyway, so was anybody able to complete these things we were doing yesterday? Anybody? Nobody. Amarachuku, you didn't do it? That's strange. Fizzy, talk to me. Did you do it? I thought you said we would do something. You people should do something yesterday now, right?
No, he said we continue this.
I said what?
That we will continue today.
Oh, I didn't say we should do anything. Okay, maybe it's
Hey,
not.
before we should do it, then we'll continue it today, sir.
Okay. All right. Okay. The responsibility is passed back to me. No, Wala.
Not really, sir.
That's okay. No, Wala. Let me open this thing we used yesterday. Mm. Sorry, I'm trying to open the Excel file so that's. I don't know. I thought I clicked it. Okay. It's clicking. All right. So here we are. We did something like this yesterday. We were trying to post into assets, liability, equity. So we're trying to categorize different kind of expenses, different kind of transactions to assets, liability, and equity. And we were able to affirm yesterday, according to what Amaratiku told us, that assets equals to liability plus equity. And that is the way accounting say it should be. Assets equals to liability and equity. Meaning that if you pick up your balance sheet, your statement of financial position, when you look at it, you see that the addition of the equity and the liability will add up to become your asset. In some cases, you see that they deduct liabilities from the assets, then they have what we call net asset. When you see equate it, it still gives you the same thing with that because you're still subtracting it, you're still following this principle. So this principle is what is applicable to your financial position. There is nothing you want to do in your financial position without this equation, it will never balance. It's not possible for you to do it without this equation. So, I think I said we should do this practice question. I said it now. These people, it's okay. So, I will give you as an assignment since you did not do it, so that we can move fast. Now we have something we call drawings. I'm sure we know what is drawings. I'm sure we know something we call drawings. You can see my screen very well, right?
Yes, sir.
Right. So we know drawings. Somebody wants to say something about drawings? Anybody? You can see it on the screen. Nobody's talking. Okay, I should be calling name. Okay. The man that is there, Babatunde, tell us something about drawings. I hope you're in a place you can talk. Huh? Tell us something about drawings. You have an idea?
Yes, let me try, sir.
All right, sir.
Drawing is when the owner of a business choose choose to withdraw from the account, the company account.
Okay. Yeah. So basically, that is just it. Drawings are money that are being taken by the owners of the business for personal use. So when they use the money that is being made in the business, for instance, the business have made a whole lot of profit or maybe small profits, but maybe how do we call it? Sapa hold the owner of the business. Owner of the business may run to the business to say, okay, I need some money, and they'll take from it. It may not be Sapa too. It may just be, okay, let me enjoy what I've labored for, Yeah. Or any form of emergency, they need the help of the business. They withdraw from it. That's money take they're taken out of the business. We call it drawings in accounting. We call it drawings. It is drawings because you are taking from the business for your own use. So they say owners usually withdraw some part of the profit and leave the rest in business to finance the growth of the business. So there's something we call um, dividend policy. So dividend policy used to talks about how you retain certain amount of money, how much you have to release, how much you have to spend, how much you have to distribute to the owners of the business. So that's like dividend policy. So here, owners of the business, so they will look at it like, we've made some money, let me take out from it and let me use it to survive. Of course, you can't take from a business that does not have money. So it is the money that the business have made that you want to take from. So basically, we're just talking about drawings, and drawings are, it's always cash. You can see it here, written here, it's always cash. There's nothing you want to draw from the business. And if it's not cash, it will be the assets of the business. So it will still be like cash. It will still be like cash in form of an asset. So, and of course, assets, cash is also an asset. Now we looking at this example here. They said Adeyemi decided to take 4,000 naira in cash out of his business, and it also takes inventory with a value of 2,000 naira. So the asset of the business are reduced by 6,000 naira cash and inventory. Of course, cash will reduce to 17,000. No, cash will reduce to 15,000, while inventory will reduce to 4,005. So that's what they will just do here. They will just take it out. So simply, this table is just to show us how those things are being treated in the balance sheet, because this accounting equation is applicable to your statement of financial position. So, sorry. So they said there's link between the profit or loss, the balance sheets, the statement of profit or loss, and statement of financial position. Statement of financial position shows. So when anytime you see when we have statement of financial position, then we have statement of profit or loss. Now, it's not statement of profit and loss, it is statement of profit or loss. Why? Because you cannot make profit and loss at the same time. It's one you will make. So it is statement of profit or you make loss. Then we have statement of financial position. Now, this statement of financial position, you anytime you see it, you see that they wrote as at maybe 31st something something something. But it is used as at this one is I've scattered the formula there. Sorry. So as I was saying, when you see anywhere you see statement of financial position, anywhere you see balance sheet, you see that it is as at. Why this one is it is for the. Do anybody know the reasons for this? These terms. Anybody? Can anybody explain? Nobody.
Statements of financial position. It will be for a particular period of time, as at that when the statement was released
Huh?
by
I'm not getting you clearly. Is anybody getting her clearly?
No, I not hear her.
Okay. Physics, can you take it again? Sorry.
as at that means it's for a particular period of time when it was released, as at the time it was the financial position was released.
Okay. What about for the
For that's with the fiscal year.
huh? Yeah. Okay. Thank you very much for that. So thank you. Thank you very much for that input. Yeah, so basically when we say statement of financial position, it is prepared in as at. The reason is because anything you see in your balance sheet, that statement of financial position, everything you're saying there, it is a function of what has transpired in that company from inception to date. If that business has existed for 20 years, you are seeing that 20 years in the statement of financial position. That time that you're looking at it, let's say you are looking at it, let's say the business has existed for 20 years. That 20 years, what you are seeing in the balance sheet, it is what has transpired in that business from inception to date. That is it. Whereas what you have in your statement of profit or loss, it is what transpired in a particular accounting year. If your business, if maybe the company you work is, maybe their financial year ends 31st December every year, you see that the profit or loss is prepared for January, 1st of January of that year till 31st December of that year. So it ends there for statement of profit or loss. But you see the statement of financial position, it will be telling you as at, meaning that from the 20 years ago that business started till today, that's what you are seeing in that statement of financial position. Now, the statement of profit or loss is for a period of time. That's what they are saying here. However, the link between the two. So profit. So when you have so they're trying to connect the link between the statement of profit or loss and statement of financial position. So let me just use this. So in the statement of profit or in the statement of financial position, we have something we call retained earnings. That's part of the equity. When you have your equity, you have retained earnings, you have there is share premium, you have all of that there. Now, this retained earning is a function of what is coming as a profit from your statement of profit or loss. So this retained earning in balance sheet, in your statement of financial position, it is the profit for the period in your statement of profit or loss. Yeah. So this is a connection. This, if, okay, let me do it this way. So let's say 2024 statement of profit or loss as profit. Profit was 1 million or maybe 100K. Yes, it is there. Now if this retained earnings, let's say as at 2023, the retained earnings stood at 500,000, right? Now, at the end of 2024, it means this retained earnings here will increase, because this is now 2024. Now it will increase. So it will now be addition of these two. That's what will be the current statement, retained earnings in the statement of financial position. In your, I think we'll still get there. I think we'll still do all these balance sheets and all of that. So you see the picture of how a balance sheet is, and some of us in practice too, we know how it is. So you'll be able to get a better picture of what it is. So, and then being this thing is loss. Let's say it's loss. It means that this one will be negative. It will reduce the retained earnings we have. The retained earnings that we had in the last year will be reduced because we're not carrying loss into that retained earnings. The posting is just when you are this posting debiting this and crediting that. How do I put? Sorry, let me admit that person. Someone to join. Oh. I thought I. Strange. Sorry, huh? So, as I was saying, this will reduce the, if it is loss, it will reduce the current retained earnings we had. And if this retained earnings used to be lost before, it will further increase to negative because we had a loss before. Now you're making another loss, and that. So the double entry principle, double entry principle, it will be debit debit profit or loss, then you credit retained earnings. So that's what we did here. On the profit or loss account, you are going to debit the profit or loss account, then you credit the retained earnings. This automatically brings that value to retained earnings. So that is a link between the statement of financial position and statement of profit or loss. And another link is the aspect whereby the owner withdraw money from the business, The owner, when the owner is withdrawing money for the business, instead the money that is being withdrawn is regarded as a loan to the owner of the business, then that will not be a link, because that will still be maintained in your statement of financial position. Because you're going to debit the what's it called? You're going to debit your that's when the owner withdraw money from that business. You're going to debit you're going to credit the bank because money is going out from the business. Then you're going to come back and debit the loan for that because it's a receivable for you now. So you are going to debit the receivable from the owner of the business, then you credit your bank that the money flows out from. But in a situation whereby it is a drawing, when it's a drawing, it will be expensed. That's what we mean. We're going to expense that money. So when we're expensing the money, it means we are going to debit your expense account. We are going to credit the drawings, the asset where the money flow out. So that's a link. So the two links is through the links that are being considered here is one, this profit or loss and retained earnings, and this profit or loss and retained earnings and drawings from the business. I hope that's clear to everyone.
Yes, sir.
All right, thank you. So we said, like I said earlier, I said there's usually assets, liability. When we deduct liabilities from assets, we call it will no longer be asset. Now we have assets. We did all of that. Yeah, I think okay. We have assets. Now, when we deduct assets from the business, I mean, when we deduct liability from the assets, we now call it net asset. That's what they are saying here, net assets, right? That's net assets. So it reduces the value of the asset that we have because now we have now taken out from that asset to settle the liability. Liability is always, I mean, a an obligation to any business that exists. So all of that, let me just run through. I think there's nothing really much in this. This will get next. Okay. So what we're going to do is okay. There's a practice question here. I don't know. Maybe we should do this. Mm, okay, let's quickly do it. Right. Let's quickly do it. Let's use like a few minutes, like 10 minutes to quickly run it. So I put the question here. You'll be telling me what to write, eh?
Okay, sir.
Thank you. You can still see my screen, right?
Yes, sir.
Because I press cancel on that and make you not go cancel the whole class, I make. All right. So we can see this. So they said Joseph began a business, began trading on 1st January 2019. The following information has been extracted from his accounting records. This is just an example. Huh? When you get to ICAN past question, you will see something bigger. So hopefully during the week, if I'm able to, if I'm chanced, we'll look into past question during the week by the grace of God. So Joseph began trading 1st January 2019. The following information has been extracted from his accounting records at June 2019. So just for us to get familiarized with how accounting postings are done, we are going to be doing it together now, right? So, I didn't know this was not. All right. sorry. Yeah. So here they said inventory as at 30th June 29. So they have all the figures here. They gave us all the figures. Then they now said inventory as at 30th 20. I mean June 2019 was 25,480. That is closing inventory, right? Now we have prepared statement of profit or loss for the 6 months ended June 30th and statement of financial position as at date. Did you see that thing I was telling you, huh? This is it. You can see here when they wanted to say prepare statement of profit or loss for the 6 months, right? When you see statement of financial position, they said as at that date. If you download your bank statement now, those of us that have big money, right? If you go and look at your bank statement now, if you download the bank statement, you will see they will write on top as at. That's what they will put on top. Why? Because that account has been operating for quite a number of years or maybe months, whichever way it is. That thing that balance you are seeing is a function of what has transpired the first day that you put that millions of money in that account till now, till the amount that you are looking now. That's why sometimes when they are joking on Twitter, they will say, look your bank account, see what see what you have done to yourself, all those jokes. It is a function of as at. That's where, and that is why that's why they call balance sheet statement of financial position. Why? Because it is your position now. The statement of profit or loss is also called statement of performance. Why? Because that is how you have performed during that year. Are we getting the message? Yes, we are.
Yes, sir.
Thank you. So now we're going to look at this. So we want to do statement of profit or loss statements. So when you are preparing accounts, always write the name of the Joseph. Joseph is the name of the business. They will now have so they said we should prepare statement statement of profit or loss for the for 30th June for the period 30th June 2019. Then I can have same thing here as my statement of financial position. So let me do this. Statement of financial position. So I can say statement of financial position, statement of financial position as at now. So we'll be putting the figures, we'll be putting the entries. Now we have sales, right? We have sales of 186,426, 184,620, right?
4620.
Thank you.
Yes.
So that's sales of 184,620. Okay. Where am I going to put it?
And which format are we using?
Which format are we using? Who is asking which format are we using? Huh? Who is asking which format are we using now? Talk to me. Don't waste time. Oh, nobody's talking again. Is it because I asked question?
Network was breaking.
My network was breaking.
Yes, it's not what you said.
Okay, I said sales. Where am I going to put sales? Statement of profit or loss or statement of financial position? Which one?
Statement of profit or loss.
Statement of profit or
Statement of
loss.
profit or loss. So I'm putting 184 620, right?
Credit side.
Yes.
That's what people said I should do. I'm doing it too. We'll see whether we are going to OSA, going to the right place. Someone want to join the call. Latecomers. Gate crasher, welcome. You're doing well. So we have purchases. Purchases will be where?
Statement of profit or loss.
So I have purchases. Now, purchases will be. What will I do to the purchases? 146 290. What will I do to it? Am I adding it?
You honestly need
You
to
add
Ma?
We are netting the purchases. So
We'll less it, right? Okay, good.
Yes.
Now,
yes.
there is something they call cost of sales, right? Do we know it? We call it cost of sales.
Yes.
Let me use good format. Now, the formula for this cost of sales, COS, is equal to opening inventory at purchases. We know it now, right? Less closing inventory. Now, here, we don't have opening inventory, but we have a closing inventory here, right? Which is this amount. Inventory as at 30th June 2019.
Sir,
And
please, I don't see your screen.
oh, you not see my screen? Are you sure? Who is not seeing my screen?
Hi, I'm not seeing anything.
Anybody? Are you seeing my screen? Every other person? Amara.
I'm seeing your screen.
Okay. Uluwatosin, can you see my screen?
Yes, I can.
Okay.
Yes, I
Madam
can see your
Aderonke,
screen.
can you log out and log in again? Thank you. So,
I can see it now, sir.
oh, she was blind. Now she can see. Oh my, thank God. Welcome. So now, so we have something we call cost of sales. Now, that's what I put here. I'm trying to explain it to us. Now, cost of sales is a function of opening inventory, hard purchases, less closing inventory. Now, we have purchases. We've put purchases, so I will not put it here. I'll put it here because we need to calculate cost of sales. Is cost of sales we are going to deduct from these sales that will give us what? Somebody help me. When I deduct cost of sales from sales, what will it give me?
Gross profit.
Gross profit. Thank you. Now, I have opening inventory plus purchases. So we don't have opening inventory. Let me just put it there. Opening inventory.
Why does this thing keep disappearing?
What's disappearing? Holy Ghost fire. Holy Ghost fire, retain it for her. Now we have closing inventory. Right? So closing inventory is how much?
25,480.
So I will add the two together, Abi.
Yes.
Keep saying yes. Don't say yes, girl. Somebody wants to say something.
You subtract closing inventory from purchasing.
Yeah, from this formula, we are going to subtract closing inventory, right? So we'll do minus. So I will add the two together. Some pim. Then it gives me this. And I'm going to do so I can add. So I can subtract this from this. It gives me 63,810. Do we have any contrary opinion? So what will I call this?
Gross profit.
Gross profit.
Okay.
Now we are moving, right? Now we have salaries. Salary is what? What do you call it?
It's an
Expense.
It's an expense. So it is sit in our what's it called?
profit and loss.
Profit and loss. So I put salaries here. I can go ahead, right? Salary is how much? 21,500. Motor expenses. Expense or liability?
Expense.
Expense.
Or expenses. 5,200. Then we have rent. Rent is an expense, right?
Yes.
Insurance. 1,110. General expenses is 1050. Then I have premises.
Now that's it.
Premises is an asset.
Premises is asset.
Oh, these people are wonderful. They sabi. So premises is an asset, Abi.
Yes.
Yes.
So we have two types of assets, right?
Yes.
Tell me something. What kind of asset is this?
Premises
Yes.
is non-current asset.
Premises
Is
is
the
a
non-current
fixed
asset?
asset. Current asset.
Why?
It is expected to last more than 12 months, which is
Ah,
a year of financial statement or financial accounting.
wonderful, wonderful. So I have premises. No need make I come this class every time again.
Yeah, no come now.
I beg you.
This people sabi book, man. I can't go
Let's
here.
on accounting.
Hello, sir.
I can't go here.
Sorry. Hello, sir. Sorry, I'm lost from the motor expenses. Can we
I'm
clarify it
lost.
again, please?
My God. Let me go and report to the nearest police station like this that somebody's lost, sir. Welcome back. So where are you lost? Where are you?
From the motor expenses. So from the motor expenses.
Okay, so it's pretty simple, but you got it up to gross profit,
Yes.
right?
Yes, sir.
Oh, that's fine then. Then you are not lost. You are with us. So motor expenses is an expense. We put it here. Salary is an expense. We put it here. Rent is an expense. We put it here. Insurance, general expenses. They are all expenses. So we put them under statement of profit or loss, right? So the statement of profit or loss, that's what we have there so far. Now, statement of financial position. So these people, your people said premises is not an expense, that I should put it in an asset. And I asked them which kind of assets. They said it is a non-current asset. And I put it there. Do you agree with them? Is it there?
Yes.
You agree with them,
A
right?
non-current
Why?
asset.
Why do you agree with them?
Because the non-current asset is a long-term liability. A long-term
It's not a long-term
liability.
liability, it's a long-term asset.
Sorry,
It's expected to
long-term asset
last.
rather.
Yes. Uh-huh.
Yes, it's a long-term
Thank you.
asset.
Welcome back. You were lost before talking. Motor vehicles. Where should I put
Thank
it?
you.
So they
Motor
choose
vehicle.
it.
It's
Ma?
an asset. It's an asset.
Motor vehicle. There was a tweet like that they were asking if motor should be classified as an asset or as an expense. I mean, as a liability. When they go and buy 2000 and I mean 1916 model, that one they chop. So we have trade receivable. So we have current
Assets.
Assets. So that's a receivable, right?
Yes.
Okay. So I put it receivable. How much?
19,500.
They wrote trade receivable. I mean, I'm writing. Let me be copying it from here. Trade receivable. Oh,
Maybe you just type.
okay. Trade receivable. Let me go be typing now. 19.5. Trade payable. Asset, Abi.
Liability.
Okay. So I'll put current liability, Abi. So I'll put current. Who is that great crasher? So current liability. I have trade payable is 15,380. Something like this is hey, no, I don't forget. Somebody wanted to join. Welcome, let's come. Somebody put something here. Oh, can you still see it now? Can you see it now?
Yes, we can.
Yes,
Oh,
I
no.
can.
Oh, okay. Welcome back. All right. So I have trade payable. I've put it there. Cash. Where should I put it? Liability, Abi?
I cannot see your Excel.
You cannot see my Excel.
Current.
Yes. I
Well,
can
can you
see
see
it
my
now.
screen?
Yes, I can see the
Just,
Excel too now.
just be patient with the network. You will always see it.
All right.
This thing is getting low. All right. So I said I should put the cash. Current liability, Abi?
Current
No,
asset.
No, that's the current asset.
Okay, say, oh, sorry. This people, the survey book.
Mhm.
16,940. Cool. So we have drawings, we have capital. Where should I put those ones?
Capital should be under equity.
Capital should be under equity. Who agree with that? Somebody?
Yeah, she's right.
Who's correct? Okay. So let's do it this way. Capital. We used to call it equity. We used to call it equity and liability.
Okay.
So we can have capital. How much is our capital? 54. Oh, we
54
have
to
drawings.
40.
Okay, let's do it. 54 to
40.
40. Then we have drawings. Where should I put it?
Would deduct drawings from capital.
Who deduct drawings from capital? Who said that? Who said that?
Shukrat.
Shukrat. Fizzy, do you agree with that? Deducting drawings from capital. Fizzy have gone to the kitchen. Welcome. Did you agree with that? Huh?
Not sure.
You're not sure. Okay. Amarachuku, do you agree with that?
Yes.
Okay. Juliet, do you agree with that? She's not here. Tosin, do you agree
Yes,
with that?
sir. Yes, sir.
Okay. So most people agreed. Let me do and see people have said drawings. So I'll now say minus 8950. How do I even let me use formula? I'm used to formula. So now if we close this account now, will it be balanced?
Until we try.
No.
Why will it not be balanced? Somebody said no. Somebody wants to say something? Somebody raised their hand.
It will not be balanced. Something is missing.
What's missing? Tell me.
The figures that we're given, or what we're supposed to
Closing
clear,
inventory
is
is not
supposed
there.
to.
Huh?
Closing inventory is an asset. It's not there.
Closing inventories and assets. Okay. Yeah, let me put it.
Current assets.
Thank you. They said I should put closing inventory. Okay. If I put closing inventory, will it balance?
Let's try and see.
Yeah, try and see that the Lord is good. Inventory. Okay, oh, I'm putting it now. How much?
25,480.
80.
So addition of huh? Oh, this thing is
Started
something something.
picking. Hello, I can't see anything. Is it my network?
Not only you can say anything from here.
Like Mr. Ibrahim is
Let
muted.
us see you. I can't hear anything, so.
Okay.
He is muted. I can't hear him either.
Okay. Let's try to message him. was used to add the profit from the POL to the position.
So sorry, huh? I
Okay.
didn't know my internet was down. I was just speaking English. Sorry, everyone. Apology accepted, right?
No.
Yes, sir. I forgive you.
Thank you for forgiving me. Thank you for forgiving me. So I was saying that what could have happened? This thing is showing difference.
So, financial position.
Yes, you say what?
It's to the financial position.
I didn't get that.
Saying our profits from the POL accounts, profit or loss,
Oh,
is supposed to come to the finance.
so if I bring our statement of profit or loss here now, the two you balance, that's what you're saying.
Most likely.
Most likely. Ah, Shukurat. Amarachuku, did you agree with that? Or you two, you are most
Yes,
likely.
our
Okay.
net profit is supposed to appear on our equity side of the balance sheet.
Yeah, exactly. So that's the truth. So, like that's what we said here. We are linking. That's the link. This statement, this profit become your retained earnings. So here we'll call it retained earnings.
Earnings.
Retained earnings. So I can bring it from here. Let's assume I see this is my profit. So profit. So if I say this minus this will give me something. So I can add up my expense.
Our expenses 35,560.
Now this our difference is now 0, meaning that we are very, very correct with all we have done so far. So good, right? So you people are wonderful people. You are making me proud already. So I'm going to for ICAN learn. Not to worry, nobody here will fail. There's grace. So we are done with that. We have been able to put that to where it belongs. So that means we are done with chapter. Is it chapter 2 now? Chapter 3? Chapter. Okay, so chapter here, sir. In case you want to copy. Chapter 3. All right, so let's quickly move to chapter 4. Let's see what we can do. So this one is the basis of accounting, like double entry principle, the double entry bookkeeping, double entry principle, everything about accounting, all the what's it called? All the one transaction happened in one transaction, this transaction happened in that transaction, something. Oh, how do I post this? All those ones that you'll be scratching your head in the office. Oh, how am I going to post this? How am I going to do this? What am I supposed to debit? What am I supposed? Sometimes you may even have to call one of your friends that you know they're very good in double entry. The basis is still double entry. That gives you chills. Are you scared? Tell me something. I don't know. Are
Oh,
you
sir.
scared? Okay, you
Hey,
know it
God.
very well, right?
I actually attempted ICAN in 2023, and this double entry just made me. So, this is like a comeback for me.
Don't
So,
worry.
I'm not seeing how it goes, really.
No, you're gonna pass once now.
Amen. Oh,
Yeah.
amen.
Okay, so when we talk about double entry, we're talking about that principle that guys, how you put transactions in where they are supposed to be. So we say double entry principle For every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. There are two. Debit the receiver, credit the giver. You see, if you can just follow this simple thing I've said now, you won't have any problem with anything anybody wants to tell you in accounting that debit is on credit or no. For the first one, debit the receiver, credit the giver. If I'm the one that is giving you money, I'll be credited. If you are the one receiving the money, I will debit you. Why? Simple. Now looking at that double entry principle. Double entry principle. Oh, sorry. So now, debit receiver, credit giver. Please, is there anybody here that have any challenge with what we have done so far? Anybody? Please speak, or if you have any challenge whatsoever. Please just speak. Thank you. PZ, are you getting it? PZ, are you getting it? Huh? No. You are not getting it. I think our network is bad. Mr. Babatunde, are you getting it?
Yes, I'm getting it.
All right, great. Now, so I said debit the receiver, credit the giver. That's one. Then two is for every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. You see, if you can just follow these simple laws, that simple principle of double entry, you won't have issue with anything called accounting. Why? Because you know what you're supposed to debit, you know what you're supposed to credit. Now, if I give you money, I am the giver, you are the receiver. Accounting is saying debit that person that received that money from you, right? Then you credit that person that gives out the money. And that is why when you are paying money out from your organization, you will always see that your bank is being credited. Whereas the expense that you're spending the money on, or the liability, or the assets that you're spending the money on, they are going to be debited because they are the one receiving the money. So it's a simple logic, right? It's a simple logic. Then for anything that you are crediting, there must be somewhere that you're going to debit. The reason is because if you credit one, you can't credit one place and leave one place. The account will not balance. It's as simple as that. Speak, for thy servant hear it.
Sir, but when someone pays money into my account, for example, maybe it's at expense at that person's end, what I get is a credit alert.
Oh, I know they will ask that question. Okay, so you see that credit alert that you're seeing, eh?
Yes.
It's actually a so that's how do I put it? Do you work? Are you working in an organization?
Yes, sir.
Do you work in the account department?
No.
No.
Okay.
That's okay. Now let me put it to you. Huh? You see that money that they are crediting to your account that you say they don't pay. I'm credited. They've credited me the way we usually use it. You see that transaction that you're looking at. It is the bank transaction. It is the bank that is monitoring that. That is the bank statement for you, not your own statement. Now,
Okay.
yeah. So if you are to do your own statement, that's why I ask if you are working in an account department of an organization. You see, if you as an individual now, let's say I send you money. Let's say I send you
Yes.
50K.
1
Being a
million.
good, no, let's talk 50K. No, don't take it to 1 million first. So let's say I send you 50K. Your bank will tell you you are credited.
Yes.
The reason why bank is crediting that money is because that money does not belong to bank. That money belongs to you. So that transaction you are looking at is the banking transaction, not your own transaction. In your own book, if you have a cash book for that bank, let's say it's UBA bank, UBA
Yes.
account, cash book, right?
Yes.
No, UBA account GL. GL. GL is general ledger, right?
Yeah.
Now,
Yes.
so your own book, this UBA, this is you.
Okay.
Let's say this UBA account now there is now bank. There is a bank statement. Let's say bank statement, right? Now, when I send the money to you, Pam, the bank will tell you Bukola paid you 50K
Okay.
for
Yes.
upkeep. I'm a good guy. I pay you 50K for upkeep. If you are to record this
Yes.
thing in your bank, I mean in your own book, in your own transaction, I didn't mean you are managing your own personal accounts. What you will do
Yes.
is that you are going to debit this place. So this thing we have debit and credit.
Yes.
So debit, credit.
Credit.
Here too, we have debit, credit.
Credit.
So bank is crediting this money for you. You say, Bukola don't credit me. Oh, God bless Bukola. Okay. In your own book, you now come Bukola, you will debit it. Why? Because that 50,000 naira is an asset to you.
Yes.
So that is where the principle of debit the receiver. You are the receiver now.
Yes.
You are going to credit me in your book. Let's say I pay you, there's nothing free in accounting. Accounting believe something must have happened for somebody to have paid you money. So let's say
Yes.
maybe I bought something from you, right? So you're going to credit
Yes.
your sales. You're going to credit your sales with 50,000 naira. This one is just your UBA account. This
Okay.
is just your UBA account, right? While this one is the bank statement being maintained by the bank. You see, this money that you are saying bank have credited me. That money does not
Yes.
belong to the bank. That money belongs to you, and that's why bank is crediting it. In the book of the bank, this bank statement, the entirety of your bank account, is a liability to the bank. Do you get it?
Okay. Yes.
This bank account is a liability to the bank, while this one is an asset.
Sorry, so why is it a liability?
It's a liability because to the bank or not to you, right?
It is not your money.
You see, if you look at your bank accounts now, let's say you have, I know you're a big madam, let's say you have 5 million there. That 5 million you are looking at, you can wake up now and say, bank, give me my money. You just withdraw the money out, pam, and you use it for, maybe you use it
They don't
for
have
shop.
control over it.
They don't have control over it. So it's not their money. They will always recognize that money as a credit. That statement that you're looking at, it is your bank statement, but the bank is the one that is controlling that. So as they are crediting you, that statement in their book
Pardon?
is a liability in their own book. All this, if I have a bank with UBA, you have a bank with UBA, all of us here, we have a bank with UBA. UBA, all the balances that were, even if it's 1 naira, that money is a liability to the bank, because you can say, I'm withdrawing my money. It's your money now. It's your money. So it's not their money. Right? Is it clear?
Yes, sir.
Madam, is it clear?
Yes, sir.
So that's credit you, credit you, credit you that we always say. It is because it is bank that is monitoring that thing. If you are to open your own general ledger personally, you will always be debiting that money that is being credited by the bank. So simple, straightforward, right? Did we get it very well?
Yes, sir.
Right. So double entry principle, that just says it. So let's just look at how it's okay. Dual accounting. My battery, right?
Mm-hmm.
No light.
80%.
This is the lights. I don't know what's wrong with
Yeah.
these people. That's why I want to leave Nigeria now. Leave Nigeria.
Please, sir, take me with you.
Eh? My wife will complain. Oh. It's okay. So accounting is a dual nature, right? So we have something we call ledger. So we have ledger. So ledger is a, how do I put it? What's the definition for ledger? So ledger is used to collect different transaction for a particular account. I don't really know how to define that ledger. But one thing I know about ledger is it's usually a T format, right? Do anybody have a better definition for ledger? Anybody? Somebody want to help me? Ledger. Shukurat, help us now.
If I'm speaking about ledger, does it also count as general ledger? If I may ask.
Yes.
So, to my own understanding, general ledger is particular accounts created to recorded particular transaction, like it is specific. For instance, you are not supposed to record an asset in a expense ledger.
Yeah. Yeah, thank you. So basically it's a ledger is created to monitor or to record transactions for a particular account. For
Yes.
instance, now you have UBA account, is a ledger. You have you have um you have expenses, different kind of expenses. All of those ones are ledger. You have retained earnings, is a ledger. You have receivables, is a ledger.
Yes.
All of that. You have different ledgers that speaks to. Now, we now have something we call trial balance. So we say trial balance is used to test the arithmetic accuracy of the ledger, whether it is balanced, right?
Yes.
We know that definition, do we? Right.
I do not know,
Many,
but I agree.
many years ago, I used to know it.
Don't you just know?
Huh?
So I can come the
Mi ò gbọ́ o. Anyway, so like I said trial balance is used to test the arithmetical accuracy of the ledger to ascertain that it is balanced. So what that means is that debit ledger, credit ledger, when you do the balance, brother, Anywhere the balance brought down, balance BD. Let me use balance brought down. Anywhere it falls, if it falls on the debit side, here you come and put it on the debit side. Debit, credit. You come and put it on the debit side here. Let's say it's asset. You put it on debit side here. And you see all this asset, liability, income, expenses. Where did I put it yesterday? I think I put it somewhere yesterday. Assets. If I can see that, I will just, okay, this one's. So all these things now. Here now, this one will be here. This one will be debits. This one will be credits. This one will be credits. This one will be debits. Then this one will be credits. Ah, sorry, I don't put debits for credit. So this way, it's help you to know that sometimes you can have assets on the credit side. Do we know?
No, sir, I didn't
No,
know.
no.
Ah, what happened? What happened? Wow. Why? Who said you don't know?
I
Sir, I
don't
didn't know
know.
before. I thought
You don't know
asset is always debit.
Okay. Okay. Funny people. It's okay. So
I'm just thinking of an instance here.
it's possible, right? It's possible. And the reason why it's possible is because it is possible again. So now let's say you have this battery. So we'll stop very soon. The next few minutes. What is that? Talk to me. Talk to me. Talk to me.
Yes, boss, before we move further, please can I ask what distinguishes expenses from liability, and why expenses is always on a debit? I'm just asking.
Okay. All right. So basically, expenses are transactions that are, how do I put it though?
Outflow
Expenses
of cash.
liability is also liability too is outflow. So now expenses are transactions that are traceable to a particular period of time. Now, for instance, so what I mean about that is that now when you look at expenses, you see that it's an outflow, of course, an outflow of resources. Liability, according to IAS 37, it says it is an obligation as a result of past events that the settlement will lead to an outflow of resources. So definitely expenses too is an outflow of resources. But then when we are talking about an expense is it's a profit or loss item. Let me use it that way. It's a profit or loss item. And how do you identify that something is a profit or loss item? Is because when you look at, okay, when we're doing this now, when we're doing this one, this particular account, we said salary is an expense, motor expense is an expense, rent is an expense. But when we go to premises, we said it's an asset. Why? Because it will not be used for just a time. It will be used for a period of time. It's something that exceeds a year. Now, all this motor expense, they are just spent for that period. Rent spent for that period. Insurance spent for that period. General expenses like that. Now, when we go to premises, we said it's an asset. Why? Because it's expected to be used for a period of time. That's why IS 16 said An asset is a resource controlled by an entity from past events, and that the future economic benefits will flow to the entity. That's the term there. The future economic benefits. The future economic, as the asset is working, you'll be getting money from it. But you cannot get money from salaries that you are going to pay. You are paying salaries for the month that you've used the staff. You've paid salary. You've paid salary. You pay motor expenses for the period that you used to service that. So expenses are basically expense for that particular period of time. Now, okay, let me use this analogy. Expenses. When you are spending money from your bank now, let's say bank, any money that is flowing out from your bank, is either it is servicing an expense, it is expensed, or it is capitalized. Now, when you spend money from your bank, is that it is expensed or it is capitalized? What I mean by that is, if you are paying for anything, let's say you pay for buying a book for your office, that book you are debiting the stationery accounts and you are crediting the bank. That's an expense. But when you are not buying, let's say you bought a laptop, depending on your organization, some organization will capitalize it. So you are debiting the assets now and you are crediting the bank. So when we now say expense, we can look at what is the weight of that transaction to determine if it is going to be something that we'll use for a period of time that will last more than a year, or it is something that will not last more than a year. Now, when we look into liability, we have two types of liability: current liability, and non-current liability. Current liability, we say it is the one that is expected to be settled within a year, right? Now, when we are recording this current liability, let's say anything in current liability, it's as a result of you bought something and you have to settle it. For instance, what do they call them? Your creditors, your payables. Now, your payables is a function of you bought something. Now, what you are buying from them may be an asset or maybe a liability, maybe an expense rather. So that's why I say when you're spending money, it's either these two happens. Capitalized means you are recognizing it as an asset. Now, when you're spending money out, this happens, either of these two happens to it. So now we now say liability is a current liability because it is expected to be settled within a year. Whereas long-term liability or non-current liability is expected to be settled more than a year. Now, where the expense now comes in is the fact that it is settled within a year, one, or it is settled within a year, or it is settled instantly. Now, if this expense is not going to be settled instantly, then we bring it to liability. We bring it to a current liability. That is why we have payable. The payable, where we have payable parts, we now say payable is a current liability. So if we bought, let's say we bought, what can we buy? Let's say we bought office stationery. Now, we now say we are not paying yet. What are we going to do? We are going to debit the stationery account. The stationery account.
Credit
We are going to credit payables. So the fact that this money, this transaction we are carrying out is a minor transaction, is something that cannot be capitalized. That is why we are expensing it. If it's something that can be capitalized, we will not expense it. So anything that cannot be capitalized is an expense. While liability is a function of whom you are owing and maybe debt that you are owing as well. So liability has everything you are owing in it. So in a nutshell, expense is anything that we incur money on and we are settling it either instantly but because the value is not something we are capital. Expense is what we spend money on and it's not capitalized. That's just the simple term. Why liability is an obligations that we are expected to settle later, whether in long term or whether in short term, right? So that's just the summarized way for it. Is that fine?
Thank you, sir. Yes, thank you, sir.
So, let's end the class here because my system is almost down. Right? So, do we have any questions so far? So good.
Sir, please, I have a question.
Right.
So, it's not directly related to the class we just had, but it's kind of related to ICAN generally. So I was taking a look. I've been perusing our materials, the one we had to download from ICAN, from ICAN website itself. And to be very honest, yes, at this particular one, Emmy Woods document. So I kind of noticed
okay,
it
go
is
ahead,
bulky. Can you hear me, sir?
There is always. I can hear you.
Yes. Okay, so I don't know. Are we to complete? Are we to read the entire thing? Like, or there are always points of focus?
I'm with you. Go ahead.
So that's my question. Like, are there like things to focus on, or I don't know if there's a way to just read smartly? That's what I'm asking about because those materials are really, really bulky.
Mr. Lale promised us summarized packs some time ago.
Sometimes ago.
Yeah.
Yeah, a couple of weeks ago, maybe 2 weeks ago or thereabout.
Okay. So
So
yeah. So to that question now, it is expected that you know every line that is in that pack. Right? Yes. You know, some of you read novels now. The boy tricked the guy. I mean, the boy tricked the girl. You read everything. No, there are some novels that are over 500 pages, and you people finish it. Now is ICAN. You have to finish it. Yeah?
Okay.
So question again. Okay, so that question that whether you have to, yes, we have to finish it. But not to worry.
But then I thought there is syllabus. So what happened to the syllabus? Is it that it doesn't count?
Or at least like reading outcomes
syllabus?
that you can base your reading on.
I have syllabus now.
Hey, this is your syllabus now.
Hey,
This is not covering the whole of the pack now.
This is your syllabus.
All right.
This one. This is your syllabus. This thing is not loading. Okay. So there's a place here they put ICAN. You see, syllabus, foundation level, accounting, right? Come and be seeing this. So you'll be able to tell them. So this is your syllabus, accounting framework, carry 10%. Recording transaction, carry 15%. So this recording transaction are those your double entry, all those ones. Financial accounting. So all these things, we must know all of them. Oh. You can see some carry 15, some carry, in fact, this one carry 20. So all of them must be known, but don't worry, don't stress. Don't fret, we'll finish it, right? So this is a detailed syllabus. You can see if a detailed syllabus is taking this two pages, 3 pages, 4 pages, 5 pages, syllabus last one. So if your syllabus is carrying all of that, you should know that. I mean, this one is how many pages? This book is how many pages? It's not much now. How many pages is this? I don't know how many pages is there. But then, like, it shouldn't be more than, is it 500 and something? I'm not sure, up to 500. This one will not be more than 3 something now.
This is
It's
what I can
500 and something.
Is what?
It's 500 and something.
Don't
What do
worry.
you
You will do
what do
it,
you
huh? Don't worry, we're going to cover all the syllables, and don't worry, you don't have any problem. Just then for the notes, I've
Yes.
I've not had time to. You can see I'm using the pack to just take us. Oh, it's 500 and something pages, huh?
And I think you promised us a recording.
Yeah. All of you, are you not following the YouTube page? So I will upload every videos that I've recorded so far tomorrow by the special grace of God.
Okay, thank you.